Hello everyone, welcome back to the channel. Today we're diving into one of the most important economic stories of the year, the warning signs emerging in the US job market. Even if unemployment numbers still look fine on paper, there are deeper signs of strain that every worker should understand. So let's break down what's really happening, what the data shows, and what it may mean for you over the next 12 months. The big picture. A cooling labor market. For much of 2025, the US job market has quietly shifted into what economists call a low-hire, low-fire environment. Companies aren't cutting staff in massive waves yet, but they're also not hiring the way they used to. This creates a strange kind of labor market plateau. Not enough hiring to boost growth, not enough firing to push unemployment sharply up. But a lot of workers stuck in place, with fewer opportunities to move or advance. While this looks stable from a distance, it's often a sign of weakness underneath. When employers hesitate to hire during supposedly good times, it usually suggests they're preparing for tougher ones. Job creation. Slowing and falling openings. One of the biggest warning signs is the drop in job creation. Monthly payroll growth has cooled dramatically compared to the last few years. Some months have even shown outright declines in private sector jobs. At the same time, job postings across major platforms have fallen. Wage growth is slowing, a major indicator of weakening worker demand. Job seekers are reporting longer search times and more rejections. A softer job market doesn't always show up in unemployment numbers immediately, but it shows up in the number of opportunities shrinking. Young workers are getting hit first. Early career workers are facing the biggest challenges. Higher unemployment than older workers. Fewer entry-level openings. More automation eliminating tasks that used to be starter jobs. This is a long-term problem because early career earnings often influence lifetime earnings. When new grads struggle to get established, it echoes through the economy for years. For companies, hiring a new, untested worker is seen as a bigger risk when the economy is uncertain. So they slow down hiring, close training pipelines, and expect ready-made employees rather than developing people internally. Hiring freezes, layoffs, and an employer hesitancy across multiple industries, tech, finance, logistics, retail, we've seen. Hiring freezes, reduced hours. Fewer backfills, lower promotion rates. Quiet or targeted layoffs. Even without dramatic headlines, the cautious behavior from employers is a strong signal. When companies lack confidence about the next 6 to 12 months, hiring is the first thing they slow down. And once hiring stops, layoffs often come next if conditions continue to weaken. Macro headwinds and structural changes. Several larger forces are shaping today's job market. Higher borrowing costs for businesses. Slowing consumer demand, rising costs of goods and services. Uncertainty in global trade. AI automation, changing workflow and staffing needs. Put together, these headwinds push companies toward caution. Even firms that are profitable are choosing to wait and see rather than expand aggressively. This is how a slowdown starts before anyone is officially willing to call it one. Warning sign: rising underemployment and hidden strain. Beyond unemployment, a major warning sign is underemployment, which includes people who want full-time work but can only get part-time hours, are stuck in jobs below their skill or education level, are taking gig work because traditional jobs are harder to land. Underemployment typically rises before unemployment. It's one of the earliest signals that the job market is weakening, even if the headline numbers still look okay. We're also seeing an increase in multiple job holders, meaning people working 2 or more jobs just to maintain income. This usually spikes when incomes stagnate and the cost of living outpaces wages, another cautionary signal for the broader economy. Warning sign: declining job. Mobility and fewer voluntary quits. Another emerging trend is the drop in voluntary quits. During the pandemic recovery, Quit rates hit record highs. People were confident enough to leave bad jobs, switch fields, or negotiate better pay. But now, quit rates have fallen sharply. When people stop quitting, it usually means fewer attractive opportunities. Less confidence in the job market. People clinging to jobs they don't like, simply because they fear they won't find another. This drop in job mobility is often a leading indicator of economic slowdown. Workers feel the shift before economists officially recognize it. What this means for you. So what can you do in a cooling job market? If you're job hunting, prepare for longer searches. Target industries still hiring, tailor your applications, and build skills that increase your versatility. If you have a job, this is a good time to strengthen your resume, improve skills, and quietly prepare, even if you're not planning to leave. Financially, build savings when you can. Slowdowns often happen gradually and then suddenly. For career development, prioritize skills that can't be easily automated and that provide value across multiple industries. The US job market isn't collapsing, but the warning signs are piling up, and they're coming earlier than many people think. More cautious employers, fewer openings, slowing wage growth, and stressed younger workers all paint a picture of a labor market that's losing momentum. If you want more breakdowns like this, hit like, subscribe, and drop a comment below. Are you seeing signs of a slowdown in your industry? I'll see you in the next video.